Economic value-added analysis. Economic value-added analysis is a method of measuring a company's true economic profit by subtracting the cost of capital employed from its net operating profit after taxes, NOPAT, essentially showing how much value a company generates above and beyond the cost of its funding. A positive EVA indicates a company is creating wealth for shareholders, while a negative EVA means it's not generating returns exceeding its cost of capital. Example: Company A generates $10 million in NOPAT with a total capital employed of $100 million and a cost of capital at 10%. EVA calculation: $10 million net operating profit after taxes minus $100 million times 10%. $0 million. Interpretation: Company A is not creating any additional value for shareholders as its profits are only just covering the cost of capital. Company B generates $15 million in net operating profit after taxes with the same $100 million capital employed and 10% cost of capital. Outcome: Company B would be creating $5 million in additional value for shareholders. Key points about EVA analysis: focus on economic profit. Unlike traditional accounting metrics, EVA considers the cost of capital, providing a more accurate picture of a company's true profitability. Decision-making tool. Managers can use EVA to evaluate potential investments, identify areas for cost reduction, and prioritize strategies that maximize economic value creation. Important factors. The accuracy of EVA relies on correctly calculating the cost of capital, which involves considering both debt and equity financing. Pros of EVA valuation: focus on profitability beyond cost of capital. EVA clearly shows if a company is generating profits above the required return on invested capital, providing a more comprehensive view of true economic profit compared to just net income. Management alignment. By incentivizing managers to maximize EVA, it encourages them to make decisions that prioritize shareholder value creation by managing assets efficiently and controlling costs. Identifies areas for improvement. EVA analysis can pinpoint specific areas within a company where operational efficiency can be improved by highlighting which assets are not generating sufficient returns. Comparable across industries. When used consistently, EVA can be used to compare the performance of companies across different industries as it takes into account the cost of capital. Cons of EVA valuation. Intangible asset difficulty. EVA can be less effective for companies with large amounts of intangible assets like intellectual property, as these are often difficult to accurately value and incorporate into the calculation. Sensitivity to the cost of capital. The accuracy of EVA heavily depends on the chosen cost of capital, which can be challenging to estimate precisely. Short-term focus. Focusing solely on EVA may incentivize short-term profit maximization at the expense of long-term growth strategies. Complexity in calculation. The EVA calculation can be quite complex, requiring detailed financial data and adjustments, which can be time-consuming.